Banks are an integral part of the world economy since the existence of money. We use them to store our excess money, to borrow in times of need. Everything looks perfect, but did you know that banks actually keep many secrets from us? Welcome to Retire Rich. We help people learn about personal finance, how to get rich, and achieve financial freedom early. In this video, we'll reveal 5 hidden secrets that no banker will tell us because they would prefer we remain in the darkness and they profit from our unawareness. 1. Money in the bank makes you poor. We've all heard the saying, money in the bank is like a money tree in the backyard. While the saying is true in some sense, it doesn't give us the whole picture. Keeping money in a bank account is definitely better than keeping it hidden under your mattress. The biggest incentive behind keeping money in the bank is that the bank pays you interest. So, our common sense says that our money in the bank will grow because of this interest. But that doesn't actually happen. To understand this, we need to understand the concept of purchasing power parity. Back in the 1990s, a Big Mac from McDonald's could be bought for around $3. But today, the same Big Mac costs $5.80. That's almost double. So the value of your $3 in burger terms has definitely reduced. Similarly, we can see that everything has become more expensive since the time of our parents' generation. This price rise is known as inflation. Let's assume that the inflation rate is somewhere around 4 to 5%. Your saving bank account's interest rate should be at least the same as this, so you can afford the same things you could afford 10 years back with the same amount of money. But you also know that's not true. Gas is pricier, so is milk, and so is everything else. You also know what all expenses you've cut down in the last 10 years, just to survive on your paycheck. And that proves your money in the bank is not growing at the same rate as inflation. On the face of it, banks generally give you a 3% interest rate. However, if you do the math, you are actually getting a negative 1% interest rate because inflation is at 4%. So, leaving money idle in banks is never a good idea if you want to maintain your current lifestyle. Instead, keeping money invested in assets that rise exponentially in inflation is a great way of storing your wealth. Some great options can be stocks, real estate, and even G-Secs if you want safer investments. 2. Your account balance is a sham. Don't we all check our bank account balance all the time? Yes, we do. It gives us the peace of mind that no matter what happens, we will have at least as much money as our account balance shows, but that's not always the case. Your account may not always let you withdraw all the money in it. The reason behind this is called the fractional reserve system. Under this system, every bank is allowed to lend out all the money they have in their deposits after setting aside a fraction of it as reserves. The reserve ratio is dictated by the central bank of the country, which is the Federal Reserve in the US. After keeping the required reserve amount aside, banks lend out the rest at a rate higher than what they pay you. The difference between the lending rate and the deposit rate is their profit. Let's look at some numbers. Suppose you deposit $1,000 in your account. The reserve ratio is 10%. So, the bank can lend out 90% of your $1,000 to loan seekers. But this is not where it ends. When your bank lends someone $900, it gets deposited in the loan seeker's bank account. This second bank again reserves 10% and lends out 90% to someone else, which is $810. And this cycle continues. So, do you know how much money is created out of $1,000 when the reserve ratio is 10%? The answer lies in your grade 8 math book. This is a standard infinite geometric progression problem. In simple words, the total money generated from $1,000 is 1,000 divided by 0.10. $10,000. Yes, this is money created out of thin air. Are you wondering why banks can do this? Well, the answer is simple. Banks operate on an assumption that not all depositors will withdraw all their money at the same time. Because of this very basic yet true assumption, Banks are able to maintain their liquidity without going bankrupt. They still let depositors withdraw money, and along with that, they make a profit too. But can you imagine what will happen if all the depositors try withdrawing all their money at the same time? The world economy will collapse due to bank failure. A real-world example of this was the 2008 financial crisis, when depositors were running helter-skelter to withdraw their own money. Due to too many withdrawal requests, close to 25 banks collapsed in the US itself in 2008. And the same happened very recently in 2023, when overwhelmed depositors of Signature Bank made a sudden withdrawal of $10 billion. This deposit exodus came as an aftershock of the sudden collapse of Silicon Valley Bank, making it the third biggest bank failure in US history. Ultimately, the regulators had to take over the bank under their protection to bring back financial stability and reinstate people's faith in the economy. 3. Low risk means a low borrowing rate. While average middle-class people borrow money when they don't have money, the wealthy borrow money despite having money. The biggest reason why the wealthy borrow is because the richer you get, the cheaper the loan gets. Even though this may seem counterintuitive to average people, it makes a lot of sense to banks. Banks lend money based on two factors: profit and risk. While profit is always the most important motive for any company, including banks, risk is even more important when it comes to lending money. If you are an average American already buried in huge credit card debt, there is a higher risk of you defaulting on a bank loan. To compensate for such higher risk, the banks will offer you a loan at a much higher rate. On the other hand, someone like Mark Zuckerberg can get the same loan for much lower. Naturally, the risk of lending to Mr. Zuckerberg is almost negligible compared to lending money to any average American. And this is exactly what happened when Mr. Zuckerberg went to take out a home loan in 2012. While the average mortgage rate was 2.69%, Mr. Zuckerberg got it only for 1.05%. That's a rate difference of 2.69 minus 1.05, 1.64%. While a rate difference of just 1.64% may not seem much in percentage terms, in money terms, this created a sizable difference. Zuckerberg borrowed $5.95 million, so the rate difference of 1.64% meant $96,580 less interest for Zuckerberg. That's almost $100,000 every year over his 30-year home loan. Or you can say, his loan was $3 million cheaper even without the compounding effect. 4. Debt is free money for the rich. Another reason why the rich borrow despite having enough spare cash is because debt has several other benefits too. Continuing with the story of Mr. Zuckerberg's loan, we can show you how you can use debt to your benefit. As we all know, Zuckerberg, with a net worth of $15.7 billion at that time, didn't even need that loan, but he still borrowed. The hidden truth behind this was that he knew by simply putting such money in an index fund at 8%, he would earn close to 7% in interest, a return much higher than the 1.05% he owed the bank. On top of that, using this loan for tax breaks, Zuckerberg saved even more money by paying lesser taxes. So, if you are smart like Zuckerberg about your debt, you can easily convert your debt into free cash. If you want to learn more about leveraging your debt, you should definitely read Robert Kiyosaki's best-selling book, Rich Dad, Poor Dad, or watch this book's summary video on our channel. 5. Credit cards are a boon for the banks. If you think bank reps are your friends, you couldn't be more mistaken. When bank sales reps try to sell you a credit card or any other product, they don't take into account your needs. They are only concerned about meeting their monthly targets, and if they are being over-friendly to you, you should see that as a big red flag. Credit cards are the biggest boon for banks, but at the same time, they are the biggest bane for you. There are several reasons for that. The first and most obvious one is that, unlike all other debt products, credit cards have one of the highest possible interest rates. It can even go up to 20% in some cases. If you shop within your means and pay your debt on time, then you don't need to worry about it. However, very few cardholders belong to this category. A survey by LendingTree shows that as of 2023, Americans have a mountain of credit card debt in front of them, amounting to $986 billion. And out of all of the credit card holders, 65% don't pay their debt in full each month. The biggest problem with credit cards is that it delays you from paying for what you buy. This removes the affordability check from our minds. We start spending without knowing how we will pay off our debt. That's how the debt spiral starts. The second, but much more subtle problem with credit cards is the processing fee. This is not the annual charges charged by the bank. Instead, it is the extra you pay every time you make a purchase. Banks charge sellers and shopkeepers a processing fee every time a customer pays using a credit card, and this can go as high as 15%. If merchants start paying this out of their own pockets, most of them will go into losses. So, they pass it on to the customers by increasing the product prices. Therefore, a $100 purchase includes this 15% processing fee, which you would never know unless you ask the shopkeeper. Finally, the third problem with credit cards is that the banks can increase the interest rates by just giving you a 15 to 30-day notice, after which it is deemed accepted. And if you are like most people, you would never look into the fine print of these bank documents to decide whether you still want to continue with a credit card or not. If you found this video helpful, make sure to leave a like and subscribe to the channel. Watch more personal finance videos.